Hello and welcome to another episode of Full Court Finance here at Zacks. Today we're looking at a few coronavirus standouts before they report their quarterly earnings results later in the week, and that is Roku, Etsy, and Square. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump in, I quickly want to do a little broader market overview, as I like to start the shows with, just to give some context of what we're talking about with Roku and Etsy and Square. So U.S. stocks jumped to start the month of August on Monday, with big tech continuing to showcase its strength. So we saw some familiar names such as Zoom and Microsoft and Apple and other coronavirus standouts all come up big on Monday. The positivity came after Facebook and Amazon and Apple all flexed their muscles last Thursday after the closing bell, proving once again that tech is one of the safest and best bets amid this broader pandemic-induced downturn. And then we also saw Microsoft in talks to buy the U.S. Leg of TikTok. And with all of this on Monday, the NASDAQ climbed to new records. Meanwhile, we also saw the U.S. report its smallest daily increase in new COVID-19 cases in the last month. Alongside that, we saw a somewhat positive sign from some factories around the world as things slowly return to something close to normal. This helps investors somewhat look beyond last week's rough second quarter GDP data from the U.S. and Germany. And it's also worth remembering that Wall Street knew things were going to be bad in terms of the second quarter growth, and they're also always looking ahead. So this could continue to bode well for the market. Meanwhile, U.S. interest rates are expected to remain historically low. So this "don't fight the Fed" mantra could be with us for some time. And we should also note that the overall earnings outlook for the third quarter is improving. So with this in mind, we're going to jump into some of the hot names in the stay-at-home stocks in the broader tech space before they report their quarterly results. So the first name we're going to talk about is Roku. That trades under the ticker ROKU, so just its name. Its shares are up 160% since the middle of March, and it's set to release its Q2 2020 results after the closing bell on Wednesday, so August 5th. So if you're listening to this on Tuesday, this is tomorrow afternoon. Roku is famous for its small devices that plug into TVs and allow users to watch streaming TV content from the likes of Netflix and countless others. The company stands to grow as part of this broader expansion of the streaming TV market that's seen the likes of Disney and Apple all joining in on the fun. Amazon's also a player. They are also a player as well. They have their own Roku channel. And Roku said in the fourth quarter of 2019 that it projects roughly half of all U.S. TV households will have cut the cord or never had traditional pay TV by 2024. And along with its devices, Roku also sells multiple streaming TV players that are various sizes. They've jumped into the sound system market. They also have their software built into various smart TVs. And as I mentioned, they're also rolling out an expanded digital advertising business in their own Roku channel, which allows users to watch free streaming movies and TV shows. And part of this also is, it's worth noting that in November, they completed their purchase of demand-side platform DataZoo. And amid all of this, they're focusing more on growing their advertising/platform business, which is where a lot of their growth is going to come going forward. And then obviously the coronavirus pandemic has forced millions of people to stay inside. And even as things slowly start to return to normal as they are, live sports are coming back on TV. It's unlikely that people aren't going to be able to attend any of these live games. People aren't likely to rush back into movie theaters, even if they open anytime soon. So all of this is setting up Roku and others to be in a positive position. So with this in mind, the company reported a narrower than expected Q1 loss, and its revenue was up 55%, with its platform revenue up about 73%. And then things got even better in April, the company noted that its active accounts grew by roughly 38% versus last year, driven by a 70% increase in new accounts, with its streaming hours up about 80%. So that's right in the heart of that lockdown in the month of April. And this kind of helps showcase, though, that the pandemic has accelerated trends that were already going in that direction, which was that streaming market. The company did say, obviously, that its growing ad business is expected to be impacted by broader cuts to ad budgets, noting that, quote, while our advertising business has seen higher than normal cancellations as overall advertising budgets have declined, this has been partially offset by ad spend that has moved to Roku from traditional TV budgets. So as more and more people cut the cord in live matters less and less, Roku does stand to benefit from this broader shift of advertisers and other marketers who are promoting their own streaming services to spend heavily on Roku. So amid all of this, we saw Google actually have their first sales decline ever as a public company based on this broader pullback in advertising. But Roku stands to continue to grow, even though it's less than they were expecting to overall. And they also noted that they saw demand for ad-supported video continue to grow on its platform. And they also saw movie rentals and purchases, that on-demand movie rentals and purchases, grow at a quicker pace after that had sort of decelerated as more people were just getting all their movies on Netflix and various other platforms that they're paying for. But with no movies in theaters, no one able to go to theaters, more people are buying those movies that are now being directly released to streaming, which you could see become a much bigger trend over the next year, or maybe until people are more willing to go back to a theater when there is perhaps a vaccine for COVID-19. And then the firm released in July its yearly study about cord cutting, and it found that roughly 32% of US TV households don't have traditional pay TV at the moment. And while another 25% were identified as what they're calling cord shavers, who are cutting back their services. And they noted that about 45% of those people are now expecting to completely cut the cord within the next 6 months. So that's going to be a big boost possibly for Roku and all of these other streaming services. And on top of that, Roku is continuing to expand its international business. It's expanding in Brazil. It launched the Roku channel in the UK. So that's their next growth front, is outside of the US and North America. So looking ahead, our Zacks estimates are calling for the company's Q2 revenue to climb 21%. So this would be a big slowdown. And the fiscal 2020 revenue is expected to climb about 31%, with fiscal 2021 expected to come in another 31% higher. So 31% growth this year for the year, and another 31% growth next year is what we're calling for now. And it's totally worth noting that this would be a big slowdown from 2019's 52% top line growth and 2018's 45% top line growth, but it still does mark strong growth amid what is this broader economic downturn, and does prove that Roku is running a business that's built for the future. Meanwhile, its adjusted losses are expected to grow significantly amid all of this, but it has seen some revisions trend in the right direction. And Roku is currently a Zacks rank number 3 hold that sports an A grade for growth and a B for momentum in our style score system. Investors should also note that Roku has historically made some pretty big moves after its earnings release. So if you're confident on a possible strong guidance or a big beat, Roku could be a big near-term winner, but it also could fall in the near term. Basically, the point is it trades pretty heavily historically around its earnings release. The stock did jump another 3% in morning trading Tuesday, and it still rests just below its 52-week highs, which means Wall Street might think it has some more room to run as the broader tech market continues to climb. It's currently trading at about $166 per share, and it's trading at about 11 times forward 12-month sales, which does mark a premium to Netflix's 8 times forward sales. But it's worth noting that Roku has traded much higher over the last year than its current price. Roku has traded at about 15 times forward sales. So it's well below that at 11 times at the moment. So you're getting a little bit better of a deal on Roku than you would have a year earlier, even though its stock is trading not too far off its 52-week high. So that's what we have on Roku. It's a decision that we've seen. We saw a little bit of a pullback from Microsoft, but then we saw the big tech FANG players, Apple, Facebook, and Amazon stock surge after they reported. So we could see maybe this broader tech push continue where a lot of people are calling for a pullback. But you really never know at this point. But Roku does certainly appear to be a stock that's worth considering as a longer term pure play bet on the streaming market, which besides Netflix, it's really one of the only pure play streaming plays out there. So now we're going to move on to Etsy, which is another stock that trades with its ticker as its name. So it's ETSY. It is an online marketplace that has seen its stock price surge during the coronavirus, as it's another one of those companies that really has benefited from the stay-at-home environment. And like all the stocks we're going to talk about today, the company reports its Q2 results after the closing bell on Wednesday. As I mentioned, Etsy is an e-commerce marketplace that allows people and small businesses really to sell everything from clothing to jewelry to art and various home decor. They have if you've never been on Etsy, just go on there. You can get a better sense of what they do. It's really for sort of at home or out of home businesses and artists and various small businesses to sell a wide variety of stuff. The firm went public back in 2015, and its shares have soared over 1,200% since the start of 2016. And then more recently, its shares are up about 280% since the market's lows and 180% overall in 2020. And this destroys Amazon and Netflix and eBay and a bunch of other stay-at-home standouts. So Etsy stock has been pretty impressive so far. The stock is sitting at about, as of this recording, at about $126 per share, and it hit brand new highs of about $129 on Tuesday morning. With that said, it's trading at new highs in terms of forward 12-month sales as well, at about 11.2 times forward 12-month sales. So its valuation has become a bit stretched with this massive run-up. So in the first quarter, which ended on March 31st, the e-commerce firm's sales were up 35%, with active sellers up about 26% and buyers up 16%. So on top of that, we should also note that Etsy said it sold about 12 million masks in April alone. So those first quarter results only had about a couple weeks of that lockdown period that was worth about 133 million, or roughly 10% of its total gross merchandise value or gross merchandise sales in the first quarter. So the second quarter saw a lot of businesses try to do everything they could to move their sales online. A lot of little shops, stores, people alone. So that mask business alone could see Etsy do really great in the second quarter. And masks might be a big business for who knows how long. So Etsy could continue to grow amid this broader push that's really made e-commerce even more important than it ever has been before, as all these quote-unquote non-essential businesses have been really impacted. So with this in mind, our Zacks estimates are calling for Etsy's Q2 sales to soar about 85%. So this would be well above its 35% it did in the first quarter, with its overall 2020 sales projected to climb about 50% to about $1.2 billion. So this would represent by far its largest growth as a public firm and come on top of 2019's about 36% sales growth. So a big year is projected and a big quarter is projected for Etsy. Meanwhile, its adjusted Q2 earnings are projected to soar about 200% to 42 cents per share, with its full year earnings projected to climb about 50%. And then we're calling for another 45% growth in the bottom line in 2021. So some significant bottom line growth both this year and next. The company also has some positive earnings revision activity. This helps it earn a Zacks rank number 2 buy at the moment. So obviously, with all these stocks, some investors might want to wait for a possible pullback with the stock trading at new highs. It's been on a massive run. With that said, Etsy could still be a solid coronavirus play in the near term, as well as a longer term bet on this continuing e-commerce market growth as Roku is with the streaming market as well. So that's what we know about Etsy heading into its earnings. And now we're going to close out with a look at Square, which trades under the ticker SQ. Like all the other stocks on this list, it has been a real big standout amid this coronavirus comeback. It's crushed the likes of Zoom and Netflix. It's up about 135% from the market's, 235% from the market's March 23 lows. And just as a reminder, it is set to report after the closing bell on Wednesday as well. So all three of these stocks are set to report after the market closes on Wednesday, August 5th. So we're just going to start with a broader overview and then some of its coronavirus problems that Square is facing. So a decade after its founding, Square has expanded far beyond its smartphone and tablet connected credit card readers that were made initially for those really micro-sized businesses and small businesses. Today, the fintech firm's portfolio includes a wide variety of point-of-sale offerings, as well as debit cards. It conducts small business loans, and its peer-to-peer payment app, the Cash App, has become widely popular. It also has other offerings as well. The Cash App competes against offerings from PayPal and traditional banking giants like JP Morgan Chase, and it's part of this broader peer-to-peer payment space that's continuing to grow. So with that said, despite its expanding portfolio, many of Square's clients, which are often coffee shops, restaurants, bars, smaller brick and mortar businesses, have been really negatively impacted by the coronavirus, certainly during the second quarter, with things expected to turn around going forward. So we should note that in-store discretionary spending accounts for about 3 out of every $5 in payments that Square processes, and this is according to the Wall Street Journal. So obviously this is a problem since a large chunk of its revenues come from these transaction fees. So the second quarter could be a problem or a weak spot for Square stock. The company said that its gross payment volume fell about 35% in the last 2 weeks of March across its seller ecosystem. So with the seller decline, it saw a big boost in its Cash App. Gross profits were up about 115%, and it added its largest number of net new transacting active customers. In March, it also saw its highest ever monthly direct deposit volumes in April, as people opted to get their stimulus checks deposited directly in the Cash App. Square in the first quarter still posted 44% earnings growth to top estimates, but it did report a quarterly loss. And this was driven by about $110 million in transaction and loan loss expenses that came from an increase in estimated reserves that it's going to need as small businesses suffer. So with this in mind, the stock is still trading at new highs, so people have clearly priced all of this negativity in the near term in. It climbed another 4% on Monday, and it hit another new high on Tuesday morning. So investors should note that over the broader term, Square is up really big. And with that said, though, Square actually did slip from around the fourth quarter of 2018 until the market's coronavirus bottom. So it had not been performing well at all until the market surge reversed on around March 23rd. As we mentioned, it's up about 235% from under $40 per share. And it's still also trading, even though it's at new highs, it's still trading below its own 2-year highs in terms of forward 12-month sales. It's at about 9.5 times forward 12-month sales, which is not far off from its industry's average. And that's a discount compared to PayPal. And it's well below other pandemic high flyers like Zoom, that's trading at about 35 times forward 12-month sales at the moment. Square did say the last quarter that its gross payment volume was down about 39% in July, and that it was improving slightly, it was improving slightly in April. So at the time it reported its first quarter results, it noted that gross payment volume was down big, about 40% in April, but it was seeing some improvement in the second half of the month. So with this in mind, our Zacks estimates are calling for Square's second quarter revenue to dip about 3% to $1.14 billion. This clearly isn't obviously not a great sign, but it does mark improvement from where its Q2 estimates once sat, and it could be far worse considering how bad things looked early on in the lockdown. And then in a sign of a possible economic recovery, its Q3 revenues are projected to come in flat from the year ago period, and its full year revenues are still projected to jump about 10% in 2020, and then another 26% in 2021. This would obviously mark slowdowns compared to the last 2 years of growth, where it saw about 43% and 50% growth those last several years, but it compares relatively favorably to its 2017 growth of about 29%. And then at the bottom end of the income statement, Square is expected to swing from positive earnings of 21 cents per share to an adjusted loss of 9 cents per share this quarter. And its adjusted 2020 earnings are projected to sink about 81% to 15 cents per share. But then if we look ahead to 2021, our current estimates are calling for a massive climb back, about a 467% jump above our current year estimates that would actually see it come in above its 2019 level. So a big comeback we're calling for in 2021. So at the moment, Square is currently a Zacks ranked number 4 sell. And this is based on some negative earnings revision trends. Therefore, investors really might want to hold off until CEO Jack Dorsey, who we should also note runs Twitter, and management provides some updated guidance, as things are still pretty up in the air for a lot of its business clients who are running these smaller brick and mortar shops. On top of that, it could just be hard to impress, like all these stocks. It could be hard to impress Wall Street investors with that massive run. Even though we did see Apple and Facebook and Amazon all continue to climb, but clearly Square and these firms we've talked about today are not in that class yet. With that said, Square, like all three of these firms, does stand to benefit from broader growth trends, this being the financial tech, that fintech space. So it might be one to keep on your watch list and see how it performs in the near term and what kind of guidance the company gives with the stock up so big over the last several months. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.